effectively mirror what I'm saying and doing in the so what I'm doing is going to go through the slide presentation that the newsletter that I send out to you is more of the written. While this is the pictorial, but I know that sometimes slides without explanation really don't do much good. So first, just want to talk about this remarkable past year that we've had where stocks have rebounded incredibly off of horrific lows, both small companies and large companies and international. It was a terrible downturn, but a remarkable recovery, due primarily to, in my opinion, to two reasons. One was the unprecedented monetary and fiscal policy. We had effectively the financial crisis as an example, and the Fed and the government just pulled out the playbook from the financial crisis and ramped it up even higher, the amount of spending that was done. So when you consider effectively what happened during that downturn, it's recovered much quicker than I ever thought it was going to recover. The good news for us at Altrius is our clients weren't impacted. You saw your portfolio values declining in value, but the income for those of you who are retired was there, just like it's been over the last 20 years. So our strategy is very boring. I was talking to Dick Fold this morning of Lehman Brothers, who it's nice to have such great performance as we've had. And with that tremendous performance that we've had, it's nice to gain like national recognition, and firms like Dick's want to talk to us and say, you know, hey, we're interested in what you're doing and your strategy, and we've been setting up meetings with other institutions because we sell to financial advisors, our asset management. So the nice thing about, I always say, is that we sell boring companies, you know, that provide dividends to our clients in good markets and in bad markets. And even though the market was going down, like it has, you know, during the 2000 crisis, like it did during the financial crisis, these bumps and downturns feel horrific when they happen. The oil crisis in 2015, 2016, and then this COVID crisis that we had. But the good news is that, as you can see from these green triangles, our clients kept collecting the income. Now, we get paid a lot less because I get paid based upon your portfolio value, but our clients' income never changed. So if you had $1 million and it went down to $800,000, your income was still exactly the same. It didn't change one bit. It stayed steady, and it stayed throughout, and it remains throughout. Although I am increasing our equity allocation right now, that has been a little bit of a detriment to our total income, but not too much. And that's because we're finding less value in the bond market right now, which I'll talk about a little later. Again, our income over the last 2 decades has just grown very nicely for our clients who, like me, if you're younger and you're reinvesting, it is a boring way. Rather than investing in what I call investing in hope, you throw it in Bitcoin and speculate, or you throw it in Tesla and you hope it goes up. You know, we're not investing in hope for our clients. We're investing in durable businesses where I know they're going to be able to pay the dividend for long periods of time to our clients. And it's a boring way, but it allows us to fight another day. I talk about the mistakes that investors make in chapter 1 of my book, where really smart investors have done really dumb things. We saw just recently Archegos blew up their $20 billion portfolio by using margin, using leverage, taking too much risk in one stock, investing in speculative companies, trying to chase the herd. You know, I wrote Invest Like an Aardvark because it's like me, big, slow, and ugly, and methodical. And some of these companies that I'm talking to, like today, Greg and I were talking to a company that was I had talked to 10 years ago, and I said, well, we're you know, we're 3-4 times larger than we were 10 years ago, but my presentation is exactly the same. This is what we do. It's boring, but it works. And it's good to see that once again through this COVID strategy that it worked, and we've recovered everything that we lost during that downturn and then some, which kind of this slide shows here during that downturn. Now, part of the problem of the S&P 500, and over the last 15 years, remarkably, the returns that we've gotten for our clients have been about the same for our U.S. stocks as the S&P 500. But we've done it with a lot less risk, and a lot of the S&P 500 is being driven by these very few stocks right now. And you saw today, like Apple had blowout earnings. We just sold Apple. We've owned Microsoft, of course, which we sold a few years ago. All of these types of companies are highly, highly priced, 100 times earnings, don't pay a dividend. And our discipline is to not, as a value investor, is to not invest in these kind of companies. It's just too speculative. We're not going to risk your life savings or your retirement savings, hoping that the price of Facebook goes up today, or Google, or Tesla for that matter. As much as I admire Jeff Bezos or Elon Musk, I don't have to pay 100 times earnings. We didn't during the 2000 crisis. In 2000, we didn't buy Cisco and Microsoft and Intel that were selling at 100 times earnings and not paying a dividend. And later on, we were able to buy those types of companies. So it was nice for us to pick them up. And we're usually in early and out early. And that Microsoft for years did nothing. It just kind of stayed flat. Many of our clients were complaining about it, but we were getting paid a nice dividend to wait. And then, of course, Microsoft just shot off to the moon. And so that strategy of sticking to our discipline of not paying too much has paid off for you over the years. Because this is the problem right now. Almost 25% of the entire U.S. economy is made up of these few stocks. And people forget this. I was having dinner with one of my son's very intelligent Bowdoin students, and I said, he said, pitch me your investment style. And I said, no. I said, when you sell your company for $10 million, then you'll like our style. Right now, you're young and you want to gravitate towards all these sexy stocks. We talked about our investment committee this week. One of our analysts 10 years ago pitched True Religion Jeans, and I didn't even know it was him. I thought it was a bunch of the MBAs at the time that I was interviewing, which would talk about it. And he wrote something in that he said, here's what you said about it at the time. He said, let the growth guys chase it. Let Fred Alger and the growth managers chase the True Religions. I said, but that's not the kind of company that we are going to invest in. It's not what we do at Altrius. Now, True Religion's gone bankrupt twice just in the last 4 years. You could have made a lot of money in True Religion if you got out before that, but that's not what we're going to do, right? We're not going to try to jump on the bus when everybody's jumping on the bus, jump on that bandwagon and hope that we're able to dive off before it goes off the cliff. That's a disastrous investment strategy, and it's not disciplined. And part of the thing that you'll see is that when I asked the very intelligent young man, I said, what was the biggest company back in 1980? He immediately said IBM. I was thinking, wow, you're really intelligent to know that. You'll notice at IBM, AT&T, you'll see a lot of energy companies. Exxon, Schlumberger, Shell Oil, Mobil were the largest companies in the world at that time. Of course, today these companies are nowhere near the size of some of the other companies that have grown to be much larger from a market capitalization standpoint. And in 1999, it was Microsoft and Cisco and a lot of these companies that American Online, which is gone. So if you invested in this, just buying what is big, you didn't do very well. So because you're paying too much for a company, you'll notice like here's what the S&P 500 has done, and here's what if you jumped on what was doing really well, how that performed over this long period of time. And the answer is not very well. So we stick to our discipline too of not paying too much for any one company. Now, how do things look right now? We always look at the worst case and the best case scenarios. And under this, I look at the doomsayer economists, those who effectively think that the world is ending and we're in end times. And I say, what if those guys are right? What if they're right? What does it look like to us if their scenario plays out? And it's not pretty. I mean, we'll lose another, if we have a stagflation type scenario, inflation kicks in, the stock market will lose 30 or 40% over the next 5 years. Now, is that possible? Yes. Is it probable? I don't think so, for some of the other reasons I'm going to talk about here. And now, conversely, we could have remarkable returns over the next 5 years. We could see international stocks grow 50%, U.S. stocks grow 50%. Is that possible? Yes. Is it probable? No. You'll see that the scenario for safe bonds is horrific under each three scenarios. So we continue to not invest in safe bonds. I'm not going to buy you a U.S. Treasury paying you 1.4% right now. It just doesn't make any sense. It guarantees failure for your retirement, and it guarantees a bad rate of return after inflation and taxes. So we continue to focus on the high yield sector as the best sector for us. This is the Goodyear Tires and Avis and B&G Foods, the companies that we're buying here. We're trying to get a 5 to 6% rate of return. And oftentimes right now, the return is just 4%. So when the yields are this low here, the opportunity, I would rather own equities, which is why we're at an above 70% stock allocation right now, because I'd rather own a Procter & Gamble paying you 3.5% rather than paying a bond that's 4% that could go bankrupt on us. So that's what I look at when I do the scenario analysis through all economic scenarios, the good, the bad, the ugly, and then our base case scenario. What do we think is going to happen? And this recovery will be driven, in my opinion, by two things. One is the COVID recovery. And the good news is vaccines are getting distributed. We're getting closer to herd immunity. And if you're an economic historian like I am, you look back at the last time we had a pandemic and go back to the Spanish flu, it took about 2 years for things to sort of clear out. So the bad news is we probably got another year of this where it's going to be sticky and we're going to have problems. The good news is that the death rates is likely, you can see, to stay lower and to continue to come down, hopefully, due to therapeutics and due to vaccines being more widely distributed. To the point where maybe the death rate for COVID is the same as the flu. We'll have to see. But we're learning to deal with it. And this is going to be a great driver of can we go back to work. We saw today Governor Cuomo and even the states that have been more locked down have announced that they're going to open up. He mentioned July 1st to be fully open. The funny thing is that what we're seeing, and I think all governors are seeing this, is that states that have locked down have not fared any better and sometimes even worse than states that have lockdown. Whether it's Montana, which I spend a lot of time in our cabin, or the Dakotas, or Florida, or Texas for that matter, versus California, New York, and New Jersey. So I think we're all realizing that this is a very insidious virus, and there doesn't seem to be any rhyme or reason about the spread of it, although we're figuring more and more out. But I think the good news is we're clearly on a downtrend, as you could see, and that bodes well for the economic recovery. That means kids can go back to school. That means people can get back to work, and that means we're on a continued recovery. The downside is we could have like Europe, where we get second spikes, and that could very well happen. The second part of the recovery has been the fiscal and monetary policy I was talking about. You'll see that it's not even close. When countries pulled out the playbook, here's the U.S. We had, you can see the stimulus was here, right? As a percent of GDP, we just massively went over that stimulus last year, and now we've done another $2 trillion. And of course, now if we put the other Biden $6 trillion on top of that, the U.S. has gone a little bit crazier than other nations, which could be inflation. So I spent 4 pages on inflation during the newsletter. but the amount of government stimulus has been unprecedented. And that has enabled us to get back very quickly back on our feet, and spending has held up, and consumers are taking that money and they're saving some of it and they're spending some of it now that we're not locked down. But the United States is not alone. We're alone in the amount that we're doing. We're doing a massive amount, whereas you can see other nations are all doing more than they did, except for Russia, during the financial crisis. So they're all doing more as a percent of their GDP, but most of them are waiting on new stimulus. We in the United States are not waiting. We are putting a lot more stimulus into this, which is the $2 trillion that we just passed, and we're Biden just proposed a lot more. So that will be interesting, and that's also unprecedented. And again, the Fed is not going anywhere. If you listen to Powell yesterday, they are not. He said, we're not thinking about rates. We're not even thinking about raising rates. They want to see inflation start to be an issue. They want to see inflation start to creep in, meaning not just hit 2% their target, but kind of go over that. And most economists, and Jerome Powell has said this, is that with the unemployment rate higher, and we have 9 million people we have to get back to work, it's unlikely that inflation will rise too quickly. Now, there have been plenty of pockets of inflation. We're certainly seeing it with second homes as people make changes in their lifestyle, moving from big cities to more rural areas. So that is a remarkable change that's occurring. So inflation could creep in, but it's unlikely until we see more employment. And the second thing is we economists talk about is the velocity of money. If you have a pile of money that was put in the middle of a table and all of us are sitting around it right now, we're not grabbing it. We're not going out and buying airplanes or second cars or second homes too much. And banks aren't lending it either. And the people they are lending it to, it wasn't like the financial crisis where no doc loans and valuations were exceptionally high. The consumer's in much better shape, and banks are much better capitalized, in much better shape today than they were during the financial crisis. So the good news is too, we should have a snapback in our GDP, and we should see some of the highest GDP numbers that we've seen since the post-war period, and that would be very very good for the economy if we see anywhere near these numbers that are forecast for our GDP numbers. And I think that's going to happen because people are getting back to work. Inflation expectations. Here's the thing about inflation is we're going to see likely some inflation just because when you expect to have inflation, what you often do is go and buy stuff quicker because you're worried about the price of something going higher. And inflation can breed inflation. So there is that little bit of fear that we could see things like coffee or wine or other commodities go higher in price relatively quicker. So that's more of an emotional thing. And again, I don't think we'll see inflation until we see unemployment get to a better level. And you can see that here. There's just so many jobs that we're not at maximum employment yet. We're still about 9 million jobs below where it was in February of 2020. So I think that the likelihood of inflation being sustained is unlikely because of the slack that we have in the economy right now. But nobody has a crystal ball. Economists, I like an economist to, when I used to fly airplanes, to weathermen. We used to call them the weather guessers. Is that they're just kind of taking the best estimate, using the best science they can, and then but they're often wrong. The weather changes rapidly, and how you and I feel can change on a moment's notice. It can be very quick. So economists are watching inflation, as I am, very closely. And again, there's two different numbers here too. There's the unemployment number, but there's the U6 number. The U6 number are those, if the government called you today and said, are you unemployed? Are you working? And you said no. And they would say, are you actively looking for a job? And you said yes. And they said, well, when's the last time you've been on a on an interview, and if you said, 2 months ago, they would say you're not in the official unemployment rate, which is why you'll see the unemployment rate go down. And they get put in the U6 number. Now, the interesting thing about U6 number too is that how many of these people are retired for good? How many people have just said, you know what, I'm done. I'm not going back to work. And then how many people have kind of lost the skill set over the past year? I think, anecdotally, I think that a lot of the people who have been unemployed have been restaurant and lower skilled workers, and they've been helped by a lot of the stimulus just to get by. So I don't think it's going to be that hard for companies like Chipotle and others as they ramp back up, and restaurant owners to ramp back up to get back to work. But there is a shortage across the board right now. And if you walk into any supermarket, you'll see 11 jobs. And frankly, the fact of the matter is that if I'm paying you to stay at home and you're making more than going to work, many people are going to make the decision to stay at home. My cousin Steve retired from Lowe's last year. I'm managing his retirement assets. The state of California is still paying him unemployment and just extended him another 6 months. He doesn't even need it. He's not even unemployed. He retired. He's retired for life, sitting out of his pool every day. Called him on his birthday last weekend. But the government is paying him, and there was no reason really to pay him. But these are some of the unintended consequences of paying people to stay home, is that they'll stay home and they won't fill the jobs. And you're seeing that with shortages almost across the board in big businesses and especially in smaller businesses. So it's definitely a challenge for business owners. And again, they have to pay people more to bring them back. And when they have to pay people more, then you and I pay a little bit more for that hamburger, and that's inflationary. That's another thing that could cause inflation to go higher. Debt is always a political football, and looking out at the many people who are on this call, the 30-something plus people who are on this call, I'm convinced we have Democrats and Republicans on here, and this has been an issue. So I put Democratic presidents here in gray, and you'll notice that nobody ever wants to go back to the Carter years when you can see that the debt to GDP was actually declining. Everybody loves the Reagan years, which were boom, boom, but we were pushing the debt up much higher. Clinton brought it down. You'll see during the Clinton presidency, Obama raised it, and then a lot during the financial crisis with Obama, and then Trump, not a conservative, he blew it up even more. And now under Biden, I don't know where we're going. Now, this is a big question I get, and I wrote a blog a year ago, is America going broke? And if you look at the companies we lend money to, they're like a young doctor. Think of a young doctor, a radiologist. Let's say he's making $400,000 a year. A bank would be happy to lend that young doctor $1 million to buy a brand new house because they know he's got great income. And if you've got a 5-year adjustable rate mortgage, in 5 years, the bank would say, all right, doc, where's your $1 million? And the doctor would say, I don't have $1 million. I've got $300,000 in medical school debt. I've got a new car. I've got a new wife. I've got $1 million house that you gave me. But I'm making $400,000 a year. My income is good. And I can keep paying. If you roll that 5-year adjustable rate mortgage into a new mortgage at maybe a higher interest rate, I can still pay my interest on that house. And I won't have to get kicked out of my house, and you, the bank, won't own my house. That's like a lot of the companies that we lend money to. They can't pay off their $200 million of debt of $300 million debt, but they're making money. They're profitable. They can pay the interest on their debt, and they'll keep rolling it forward. That's what you're seeing on a lot of your bonds that are getting paid back. They're repaying us, which is wonderful because we hate when a company goes bankrupt on us like JCPenney. But I hate to lose that 8% interest rate that they're refinancing back. So we have to deploy that money in another company. The question mark for economists is, what's the right GDP debt to countries like Iceland and Ireland have gone bankrupt at 30% debt to GDP, and the Carter administration certainly struggled, and America was in a horrific recession, as you could see. Two of them actually in the 70s, and then in the early 80s, Paul Volcker had to raise the interest rate dramatically to stifle off inflation. I don't know what the right number is as an economist. I'm usually comfortable here. I don't like that we're up at 100 times debt to GDP where we were during the World War II, where we had to fight off our to withstand our way of life. Now we're in unprecedented territory. Japan has certainly been at 200% debt to GDP. Maybe like companies, maybe countries should be at 300% debt to GDP. And maybe they have just as much probability as going bankrupt as countries that are 30. So maybe larger countries like the United States or Japan, larger economies, can withstand that because people feel that our tax base is broad enough. Now, eventually, what can happen here too is that you can, it's like the Laffer curve, right? If you look at how much you tax a person, if you tax a person zero, government revenue is zero, right? If this is the tax rate here, and normally Democrats and Republicans will fight over this, and this is your revenue R. If you tax me zero, the government gets zero. If you tax me at 100%, you're going to get zero too, because I'm not going to work if I have to give all my money back to the government. So Democrats and Republicans will fight about what's the right tax rate. You know, is it 28%? Is it 38%? And then states, of course, will put additional taxes on that. And people can vote with their feet now, especially post-COVID. Lots of New Jerseyans, including me. Now I'm a Montanan. I am no longer a New Jerseyan. I have a Montana driver's license. I vote in Montana. I live in Montana. I pay taxes in Montana. Here's my Montana driver's license. And I'm gone. I'm out of New Jersey because New Jersey's killing me. And my son wants to graduate from high school, but I can manage money from anywhere, right? I mean, it's not, there's no difference between managing assets in Montana versus New Jersey or North Carolina or Florida, for that matter. Florida has zero state tax, so you're going to see those states continue to grow. And corporations' profits are doing exceptionally well. So companies in New York City like Goldman Sachs, two things are happening. Their employees are saying, hey, I want to live in Salt Lake City, or I want to live in Austin, Texas. And Goldman Sachs is saying, go right ahead. Some corporations are shutting down their headquarters completely. And then some are saying, you know what, we're moving our operations to Salt Lake City, and you're going to take a 60% haircut on your pay. And that's going to help their earnings because now they're not paying high rent in New York City, and also they're not paying their employees as much. So that really helps their bottom line. So that's helping their margins also. So should you be concerned about this high debt? Yes. As patriots, we could all debate, between extreme socialism and, extreme capitalism. But as capitalists who are looking, and as investors who are looking across the globe, capital will find an outlet somewhere. If the United States gets uncompetitive, companies we own, like Eaton, which is an Ohio company, just said, goodbye, America. We're an Irish company now, or a Swiss company, and they will move. And it's easier for corporations to move too, especially when you look at a lot of the companies we own. They're headquartered in America, like Intel, but 80% of their revenues come from overseas. So it might not make sense for Intel to remain as an American company. So this is a great debate. We're in unprecedented territory, and we don't know the answer to this. I don't have an easy answer for you on this question. You can read my blog on Is America Going Broke for a more thorough discussion on it, but I wanted to discuss it because I know it's on everybody's mind. The American consumer is in great position right now. You'll notice that, and you'll wonder, like, hey, we're in gray. If you look at, I was showing our investment committee team this earlier this week, during every recession, well, what happens? Spending, this brown line, goes down. It did it in 1960. It did it in 1973-74 recession. You'll see the downturn. It did it during every recession that we've had in the early 80s when we had stagflation. During the 1991 savings and loan crisis, when I was graduating from the Naval Academy, I was glad to have a government job because all my friends couldn't find them. Spending always goes down, except look at this. In this case, spending went up dramatically. And you could ask, well, how did that happen? Well, it happened because the government just wrote a check and just said, here's $1,400, and here's another check for you. Go out and spend. And what you'll also notice is this green line, the personal consumption, only went up a little bit. So what did the consumer do? Well, they didn't spend all of it. They only spent a little bit of it. Their income went up dramatically when the government threw all that money out there. And those of you who got it, don't feel badly. You've been paying taxes. Think of it as a refund of your taxes. I told all my business owner clients who got the PPP, they're like, yeah, we really didn't need this $200,000. And I said, Doc, how much did you pay in taxes last year? Yeah, $500,000 I paid in taxes last year. I said, well, think of it as a refund of 1/4 or 2/4 of your taxes that you paid last year. It was to hold you over so that you didn't have to lay off any of your employees. So for those of you who got the checks and may feel a little bit of guilt for it, you can A, give it to charity, or B, just think of it as a refund of your money that you paid for your taxes. The savings ratio has gone up, so a lot of people just put in the savings. They did not go out and spend it. So they're in good shape. Now you're starting to see people go, you saw like car sales go down. Car sales are not back where they were pre-pandemic, but I expect that the next numbers we see, people will go out and start getting new cars pretty soon. Again, corporate profits have dropped significantly during this recession, but they have held up still higher than historical standards, and I think you're going to see profit margins move higher again relatively soon. So what's our investment outlook and how are we positioning portfolios? This is all a lot of stuff and looking at the economic tea leaves and where we should be. The earnings season that we're in right now has been extraordinary, and we're doing very well. A lot of companies are exceeding all analyst expectations. I could literally throw a baseball and hit 5 Wall Street analysts around my house here. The Raymond James healthcare guy, the tech analyst, and I always know what they think. We're usually on the other side. They're usually hating particular stock or a stock that's down cheaper. We're usually buying it and waiting patiently while you get paid for that stock price to recover. They're usually jumping on whatever's hot because they got to keep their job on Wall Street, so they're usually chasing growth. And our stocks are really coming into play now. This has been because of those 6-7 stocks that are driving the S&P. Value has underperformed for a remarkable amount of time. That value has underperformed growth. And all of my young analysts, they're like young people. If I ask them what stocks they like, and I see what stocks they buy, they're the True Religion, they're the Spotifys, they're the Splunk softwares. They're the things that are sexy. The things I would never, ever, 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 ever buy for you. Too expensive, don't pay you a dividend, purely speculative, investment on hope. It's the stuff you could buy when you're 30. And if it goes bankrupt, you got plenty of time to make it up. When you're 60, 70, 80, or even 52 like me, it's harder to make it up when you have something that blows up in your portfolio. These companies, if I asked MBAs who are newly minted back when I founded the company back in 1997, everybody back here was talking about value. Everybody here was an acolyte of Warren Buffett. And because there was decade upon decade of value outperforming growth. And then we had the tech bubble. We kind of know how that ended. That ended very ugly. But where are we now? It's going to unwind. These companies can't grow to the moon. And we're seeing it this year. Is this trend going to continue? I don't know. Either way, I don't care. We're not going to invest in those stocks because they're just not the types of companies that we buy. I sat down online with a prospective client last week, and she said, I've got $700,000 in Tesla. I've got $500,000 I'm buying in Bitcoin, and I put all my money in Kathy Wood's ARK Global. I got another million something with her. I said, I'm the anti Kathy Wood. I am slow and steady. I am not for you. We are not. You're not a good prospect for our firm. And I think she was taken aback by that. I said, that's just not what we do. I said, this is not going to end well for Kathy Wood. And to my young analysts, I told the story of a guy named Scott Schotzel in the Janus 20 fund back in 2000, who was buying more after his high-flying returns, was buying more and more and more of that stuff as it would continue to go down. It doesn't end in a snap. It usually ends a slow, horrific death, or where it underperforms for a long period of time. Expect value stocks, our types of stocks, to come back. Now, we've done the same returns as the S&P 500 over the last 15 years. So many of you who are on this call, for our stocks, our U.S. stocks, we've done just as well as the S&P, and we've done it with a lot less risk, and we've done it with triple the dividend yield. Slow and steady wins the race. The other side of this is international. What you'll notice is U.S. stocks have broadly outperformed international, and this also goes in cycles. And I'm expecting international stocks to stage a recovery here, especially in Europe eventually. I don't know when. We haven't seen it this year yet, but international stocks are doing well. And eventually Nestle and Unilever and GlaxoSmithKline and Sanofi, Aventis, these companies will eventually start to outperform the Pfizers and Hershey's and U.S. companies. And that's why we own both U.S. and international stocks. And you can see that because international stocks are a lot cheaper than U.S. stocks right now. This is the challenge, is that you are going to get no return from safe bonds. There's just nothing out there. And this guarantees low returns for us. So it's a big challenge for retirees. Where do they get the income that they need to live off of? Well, they get it with our strategy, right? They get it from the types of bonds that we're buying, where we're getting that 4 to 6% rate of return, and we're trying to get that 4 to 6% rate of return, and they're getting it from our stocks, which are paying you that dividend. And this kind of shows you from a bond perspective, the bond returns over longer periods of time, in this case 5 years, the yield that you're at right now is the yield that you're going to get. Unless people get scared, unless they drive the price, even higher and driving the yield even lower, bonds are not going to get a good rate of return. You can see if you started out with a 6% yielding bond, you got about a 6% rate of return over that period of time. Right now, we're here. We're in unprecedented levels, and that's the rate of return you're going to get. And I can't buy this for you and get you to a safe and comfortable retirement, because you will be immediately dipping in the principal if I buy a treasury for you as you fund your retirement income needs. The duration is also getting much longer. Now, high yield bonds are not as sensitive to duration because if interest rates are rising, that means the economy is doing well. That means companies are having higher profits, and those companies on the margins, the Goodyear Tires of the world, are able to refinance at actually lower rates. So they're not as interest rate sensitive. Although our portfolio is just over 3 years right now, we're still staying relatively short term. So where are we at? I own the same stocks and bonds that you own. When I sold Apple for all of us, I sold it in my portfolio too. Everybody at Altrius in our retirement plan has the same stocks and bonds that you have. And we're invested side by side. We're right at about 52% U.S. stocks, 22% international, and you can see about 23%. This is the largest allocation going into the recession of January last year. We were at 50% stock. So throughout the year, I was able to buy stocks that I felt were very, very cheap and increase our equity allocation. Plus our bond portfolio, as it's getting refinanced and as we're losing these companies, we're finding fewer and fewer opportunities in the fixed income sector for you. So again, I'd rather own a stock that's paying you 3.5 with growth potential than a bond that's only paying you 4 and has a potential of going bankrupt. We always look at the world from a global perspective. Our portfolios right now, half of the revenue is coming from outside of America, almost half. And that's important because, again, we could get bogged down in politics, but like I always say in my book, in our investment committee meetings, what does this have to do with how much Starbucks is consumed in China, or how many hamburgers are consumed in Europe, or how many Pepsis are consumed in India? And if the answer is not that much, then don't worry about it. We've performed very well against strategies that provide income, and this is more of an institutional pitch here. But so with that, I'm going to open up the mics and take your questions and see if you have any questions here. So I'm unmuting everybody here, and throw out any questions that you may have. May get noisy. So. Any questions? I couldn't have answered
Jim,
every
could
question.
could you give us an explanation of what you think is going to happen to the dollar in the short term and midterm?
Yeah, my answer is I have no idea. And I'll say this: the funny thing about the dollar is, for years, currency takes, like, if you look at the dollar versus, say, the euro. Let me go through a chart here. I'm just going to mute it. I think I muted myself. Can you hear me all right? If I looked at a chart here of the euro to dollar, for years I thought, why is the euro, so overpriced relative to the dollar? And it takes sometimes decades before you can kind of see here the euro falling off relative to the dollar, and the dollar strengthening relative to the euro. I mean, this was frustrating. It's important that we be, in my opinion, diversified. That slide I was showing earlier about being globally diversified, because currencies are confounding, and I've seen really smart PhDs blow up their portfolios trying to gauge, what a currency is going to do. And so I never try to hedge, nor do I try to guess what a particular currency is going to do. Even over a 5-year period, I would think that the dollar is still going to hold up relatively well. And I say that because my assumption is that everybody's in the same boat that the United States is in. We're all in a bad place, and we're all inflating our currencies. And the U.S. dollar, the U.S. is still the prettiest girl in the room comparative to the rest of the world. And the United States has a natural advantage in that we are able to, that China doesn't have the advantage. People aren't going to. Switzerland's too small, and China is unable to be used as a global currency reserve. They may get there. The United States, we could certainly screw it up. It's possible that we screw up our natural advantage that we have with the U.S. dollar, and Congress could screw it up if we just blow up our debt, where people start to feel that the United States is not able to repay the debt that we have. Then the dollar will certainly lose its value. But my assumption is, in the short term, that you see this little increase here in the euro versus the dollar. My assumption is you're not going to see this get back to anywhere where we were near like 2008. I think we'll probably stay. In my opinion, it should be equal. But we may see it kind of come down again here in the short term as Europe figures it out. And maybe some of that has to do with our spending, but I think these things take such a long time to play out. But it's why I really feel it's important that we look at and own companies that are globally diversified, so that we're always going to have some currency risk in our portfolio. But you, as U.S. investors, we're also invested in ADRs primarily, so it's not going to be as impactful from an interest rate risk. Again, unless you're traveling, right? And I often explain currency differences and think of it as like Swiss chocolate, Nestle versus Hershey's chocolate, U.S. chocolate. Well, they're probably equal, right? I mean, some of us may prefer Nestle chocolate, some of us may prefer Hershey's chocolate. We own Nestle, we don't own Hershey. But if the euro is declining significantly, or the Swiss franc is declining, even if you like Hershey bars, you may decide to buy that Nestle chocolate because it's just so cheap. And then as dollars are transferred into Swiss francs, what will happen is the Swiss franc will rise. And then all of a sudden people start to say, oh, a Hershey bar is now just as cheap in the United States, I might as well buy the Hershey bar. And that's the way, but global trade is very complex, and it takes such a long time for these changes to occur. Sometimes it's as simple as the interest rates. And if you look at to look at the interest rates right now, you have to pay other nations to hold your money, which is, I mean, look at France. So here's the French 10-year bond. The French bond is at well, the 5-year is negative. So you have to pay France. If you buy a 5-year French bond, you have to pay France to hold your money. Same is true for Switzerland. Same is true even for 10 years for Switzerland. Same is true for Japan is negative. Germany is negative out to 10 years. So if you buy a German bond, you have to pay Germany 0.2%. So you think our interest rates are low in the United States? They are. You know, our 10 years only at 1.6, but 1.6 looks really good. In Canada, you can see it's 1.5. 1.6 looks really good compared to negative, or even Italy. I mean, would you really prefer to buy an Italian bond right now and only get 1% when you can buy an American at 1.6? So the answer is you're going to prefer America. It's one of the reasons why the Fed doesn't want to go to even lower rates we have, and that's going to stir investment to come to America, which means the dollar should actually appreciate. But again, these things can take year upon year before they actually happen. But I don't think the dollar, our politicians can screw it up, but they would have to do it epic proportion and do it over the next 5 years. And I don't put it past them doing it. They're certainly capable. But hopefully we'll find some reason. It's why I love divided government. Divided government forces compromise. And in this case right now, we don't have divided government. But it's razor edge. It's going to come down to a few senators. I know there's a lot of people I hear from my clients. They feel like, geez, I really just couldn't stand Trump, and I voted for Biden because I felt he was moderate, but holy smoke, he's going so far now. What happened? Well, that happens, and right now the Democrats have full control, so they're sort of able to control what they want. And what America will do is America kind of goes in waves, and in 2 years, the Republicans may win the House, they may get the Senate back. You know, America goes in waves, and we're pretty center left, center right. And when politicians go too far one way or another, usually America reels them back in. So I didn't really answer your question completely because I don't know. Hopefully I gave it my best answer there. I think I muted everybody. Did I?
Thank you, Jim.
Any other questions out there? Covered everything I thought was on everybody's mind, but sometimes somebody comes up with something different. I didn't cover the dollar. That was a good question.
Jim, you didn't cover the Bitcoin, did you?
No, other than to say that, like my blog is, you know, Bitcoin, I think nations will eventually get some sort of cryptocurrency. There'll be a crypto dollar. China's already working toward a crypto currency, and I think nations are going to have their own due to the blockchain technology. But I have no idea if Bitcoin's going to 0 or Bitcoin's going to 100,000. My assumption is that currency has to be three things. So, and Dick Fold, the former president of Lehman Brothers, when I was talking to him this morning, he said the same thing I did. We were on the same page. We had two things in common. We both hit senior officers, which hurt our military career, but both worked out pretty good for us. And we have the same feeling on crypto. Is that I believe that crypto has to be a store of value, right now, if you're paying somebody for something in Bitcoin, it could be 5 or 10% less a day later. So that it's not a store of value yet. It may become one. Currency also has to be a medium of exchange. And right now, you know, you don't pay me in cryptocurrency, and it's hard to buy some things in cryptocurrency. That may change also. But thirdly, and probably most importantly, is currencies, like we were talking about here, the interest rates on the nation is backed by the taxing authority of that country. Who is backing Bitcoin? Nobody knows. So when we have the next crisis, will you feel confident with your money in Bitcoin, or will it just plummet? I mean, gold plummets too during a lot of crises also. Gold is good as an inflation hedge. When you have high inflation, gold will go higher. What will Bitcoin do? And honestly, I believe the blockchain technology is amazing, and that's here to stay forever. But these other currencies, I don't know if nations are going to accept that either. They may quite likely abolish them. So I don't know if Bitcoin's going to 0 or 100,000, but I would say if you're invested in it, which I'm not, don't invest anything that you're not willing to lose, because it's a pure speculation. It's not investment. I can value a company. I can look at Bank of America or Exxon or my company and say it's worth X because I can look at the profits. When you're looking at something, even a commodity at least has some usage, right? The gold on my hand here can be used for certain things, in you know, connectivity, but it doesn't have a lot of usefulness. The coffee I'm drinking has some usefulness. It's giving me some caffeine right now. But Bitcoin doesn't have any usefulness on the things that make a currency right now. So I'm confounded by it, and we'll have to see how it ends. But I would be very careful not to invest anything or not to speculate anything you aren't willing to lose. Would be my guidance on Bitcoin. Like I sent out, you know, a year
Jim, I'm
ago.
pleased that you don't have any of our money in any Bitcoin risk.
Yeah,
Thank you.
We definitely won't be. Yeah, we won't be investing in Bitcoin.
All right, thank you.
Hey, Jim, to that point, you suggested earlier that our GDP may grow 6 points this year. But what sectors do you look to drive that growth?
So, healthcare is one, Paul. I think, you know, J&J is going to be I would say a part of that. But I would say it's good. There are certain sectors that aren't going to be a big component of it, you know, and one of them I would say would certainly be utilities. I think that utilities are changing. If you look at Montana, half of it's hydro, water, and half of it is coal. And I think the energy component is going to go a lot with the price of oil or the price of coal. So I don't see a lot of growth in the energy sector. I think most of it's going to come in the more broadly, you know, the consumer cyclicals, consumer defensive, your financials, healthcare. I think that's going to be driving the great portion of this growth in the coming year. I don't think it's going to be real estate. Real estate's kind of fascinating because I think you're going to see footprints drop dramatically. I mean, look at our staff, right? Half of us work from home. A quarter of us work from home previous to COVID. So COVID was not a big deal. We're paperless. We've been on the cloud for 15 years. So it was easy for us all to work from home. We went from 3 offices to 10, you know, because everybody was working from home. And some of our associates have decided they want to stay at home. And I don't have any problem with that. I think it's, you know, we can work just as easily from home, and some people feel they're more productive. So I think real estate is not going to be a big driver. Commercial real estate is not going to be a big driver of our growth. Personal real estate's kind of bumping up right now because people are shifting. I get calls on our house here in New Jersey. This dump I live in, 1933, you know, house that's beat up because people are just migrating out of Manhattan. They want out. They want the ability to go in on the train to New York City 2-3 times a week, but they want to be able to work from home. They want a better balance to their lifestyles. Californians are flocking to Montana. And we're seeing that in North Carolina, right? There's a lot of Northerners, New Yorkers, New Jerseyans moving down to North Carolina, moving to Florida. So I think personal real estate, residential real estate, home builders right now are behind, so home builders are doing exceptionally well. I think all of those sectors are gonna benefit from the growth. So my answer is most sectors, with the exception of commercial real estate and utilities.
This administration seems hell-bent on destroying the energy sector. Do you think there's an opportunity there, considering 99% of automobiles are still, use fuel, homes, electricity?
Yeah, I do. So we own Exxon. It's one of the few energy companies. I didn't think oil prices, and frankly, it caught me off guard that it went up so fast. I wish I would have bought Chevron also at the time, and even a British Petroleum. But now that prices where oil is right now, I don't think it's going to go too much higher. And liking to own companies as long as I do, I think you're going to see renewables continue to eventually and gradually, but you're seeing Ford and General Motors and all of the car competitors now kind of getting ready, whether governments force them into more electric, which right now is fueled by coal because we plug in, it's coal plants that are ironically, and who knows about the batteries and whether these things are really good for our environment or not. That being said, I think there's some opportunity in energy, but I'm not the most bullish on that sector. We're basically neutral on that. We only own Exxon. We do own energy companies with our debt because there's a lot of wildcatters out there that are very nimble, and with fracking going sideways, we're lending money and finding some value for companies on the energy sector on the bond side. But I may have missed some of the upside or most of the upside. Exxon's been remarkable for us. At prices where they're at right now, I'm a little bit reluctant to buy more energy, especially with the administration being so anti-energy.
Yeah.
And that's globally too. That's really around the globe. You're seeing that change.
I didn't realize you moved to Montana.
Well, I haven't moved. My wife has moved. She's lived there since last summer, and our youngest is going to school there. Well, she went there so that in Montana, they weren't shut down. Kids were going to school, whereas here, it's funny, the public schools are closed, but the private schools, our youngest son goes to Catholic school, so he's been able to go to school. And he wants to finish high school here. So every 2 weeks, I go back and forth. I've been going back and forth between Montana, and it's actually given me quite a good idea about what's going on in the economy. I mean, earlier on, if I was taking a train into the city, I was the only person on the car. Planes were empty. Flights were, now airports are full. Planes are full. And it's nice to see what's happening as we kind of get back to work. But yeah, I've been going back and forth. And when he graduates in a couple of years, then we'll always have to have a New Jersey office because we need a New York presence because we sell to financial advisors across the country. So I'll always have an office here in New Jersey. But I think I prefer, it's funny is I like working. We have our morning meetings at 6 o'clock in the morning, Montana time. I like getting up, getting early, getting the meetings out, and I'll go for a bike ride or a ski in the middle of the day for an hour or two, and then get back to work and work into the night. And I kind of, in New Jersey, in New York area, I go to bed at 12:30, but out there I usually go to bed around 11. It works. I like the mountain time works very well for me, and it gives me an idea. I always say that the further I get away from Wall Street, the smarter I get.
Where in Montana are you calling home now?
It's Whitefish. It's all the way in the northwest corner. It's a beautiful Glacier National Park is there. If you've never been there, it's a remarkable. Having seen so many places around the world, it's incredibly beautiful. But don't tell anybody. We don't want any more people moving there. It's very
it's
quiet.
Too late for us in North Carolina. I'll tell you that. Everybody and their sisters moving down here.
Everybody's coming. I mean, Raleigh, Durham is booming.
Unbelievable.
Yeah. And Apple just 3,000 more jobs, right? Apple.
I know. $1 billion investment. Incredible.
Yeah. Good for Raleigh.
Maybe time to move to Whitefish.
Yep. Come on out. You'll love it, Paul. It's beautiful. The only thing you got to worry about is the weather's great. I mean, sometimes we get the minus 20 degrees, but it's drier. So 20 degrees out there feels like 40 in North Carolina, so or New Jersey, because it's so dry. But you do get those minus 20 days too, and we were biking the other day last weekend, and then we were going back home, and about 50-mile-an-hour winds and a snowstorm. This was a week ago. So you never know what you're going to get in Montana, but the summers are amazing. It's dry, sunny almost every day, and the weather's like 70, 80 degrees, and it's beautiful. No bugs. The only thing you got to worry about is grizzly bear. You got to worry about grizzly bears. So I keep my 10mm on me in case I run into a grizzly, because they.
What's the personal income tax rate in Montana? What's the personal income tax rate in Montana? The personal income tax rate in Montana.
Montana's high. It's 6.9%, so it's much higher than Wyoming, which is 0. But the cost of living is relatively low. Hopefully Montana will come down. They just switched to a Republican governor, and that may drive the overall income state tax down a little. But that was the one downside, is that I'm saving compared to New Jersey, but not compared to North Carolina or other states that are 0. So, but the cost of living is very low in Montana compared to even North Carolina.
Great, thank you.
Any other questions? Lou, you always ask good questions. Don't you have anything? Usually you got something for me. Nothing? All right, well, I guess I'll call it a night. If you have any other questions, as always, feel free to give me a ring. And it's nice to see a lot of you. At least I can't wait till we can see each other again. We're going to have a dinner in New Jersey next week. I'm excited to actually see some people in person. I'll see you, Joe and George. So, and then we'll have something in North Carolina relatively soon, I hope, at least by the fall. We have a lot more gatherings, and I want to make sure everybody's safe too and vaccinated. So look forward to seeing everybody. But thanks for joining me tonight.
Thanks, Jim, for hosting.
Thank you, Jim.
Bye-bye.
Thanks.
Thank you, Jim.
Bye.
See you later, Jim.
Yeah.
Jesus. See the green up there, all this stuff.
Is that Clay? No. Yeah,
Yeah.
Gene. Hi, Clay.